Welcome to another real estate industry update. I'm here with Kyle Paxton, part of the real estate segment team here at James Moore Company. And today we got a fun topic. It's about debt maturing and capital calls when it comes to real estate funds. Something that I think is on a lot of people's minds if this is in your industry and where you're at. There's a lot of debt is coming up due right now, and it's not as cheap as it once was. So, so what are two CPAs basically going to talk about here when it comes to it? So let's kind of just start off with kind of like the current landscape. Okay. Um, Basically debt maturing just means that in the concept of real estate means that, hey, I went out and I got some financing and my term is coming to an end. Okay. So I owe this money back. All right. Most people, when they're going to get real estate, they're not getting like their normal homes. They're not getting 30-year fixed rates 30-year loans on fixed rates. So it's shorter. It's usually 10 years or less. Okay. So that just means that when the debt matures, it matures a lot quicker and it comes around a lot quicker than you're thinking about it. Okay. So now we have potentially have a big cash event because we got to pay it back. Or more than likely, we need to go out and refi new debt to basically pay this off and to cover it.
If you're going through this process right now, I can assure you you're not alone. We're hearing this from all different sides. Everybody's going through this process or about to come up on it. Definitely being prevalent in the industry right now.
And the market's in a different place than probably when you first got this debt. There's a lot of rising interest rates. They've calmed down a little bit, even gone down a little bit, but they're still most likely a lot higher than when you initially first got that debt. And a big one that I'm seeing is there's just tighter lending standards. Okay. Banks are just not throwing their money around right now. And that really needs to be a big part of you when you're going out to find new debt. Like interest rates matter, but if no one will even lend to you, it doesn't matter what their interest rates are. So we're going to talk a little bit about how this kind of affects you and like what can you do to get around this, make sure that you're getting the best interest rates and you even get someone to lend to you. And then with declining property values, property is kind of significant amounts. Okay. So it's kind of settled off. It doesn't mean that it's reduced a lot. It just basically is settled off. You're not getting that crazy amount of appreciation every year. That also has an effect on how you're refinancing models, and especially if you're doing your cash out refis. Okay. Um, with a lot of basically real estate funds right now, they're just struggling to make sure that when they have large amount of debt maturing, that they're able to basically get new debt, get it in the most efficient way possible so that they're still having good net operating income going forward and making all their investors happy.
Yeah, the key there is making the investors happy, right? The interplay between this and capital calls and all of that becomes real fun. And it's important to stay on top of your communications across all of this.
Right. So, I mean, what investors hate to do is put more money into a fund. All right. I mean, they know they have to make some kind of initial investment into the company, but when you're like, hey, I need more, there almost no investor is going to be happy with that.
You're definitely not going to be excited about it, right?
Right. Correct. And this is what is basically called capital calls. Okay. When the company or the fund needs cash to whether pay for their expenses, pay for its debt, or new opportunities and investments, there's only a couple ways you can get that. Okay. If you're unable to get new debt or more debt, you're basically going to have to use your investors or your owners in your companies. And this is called a capital call. All right. The big thing with capital calls are investors hate them and they don't want to be surprised by them. But they could be absolutely necessary. They're not, I mean, they're usual part of a fund. Usually it's when you're doing the normal operating agreement, it's structured in there if a capital call is needed. Surprise capital calls is not what anybody wants. If I know it's coming, that's different. Okay. Also, what is my capital call paying for? It could be just I need to keep running the business running. That's usually not a great answer to what your investor wants to hear. But it could be like, hey, there's more opportunities coming up. We're looking to invest in the new opportunities. And so we're going to do a capital call here. And that's kind of, a better capital call. But in this aspect that we're going to talk about is more about debt maturing. And you might need to make a capital call to basically pay off this debt if you're not unable to restructure your debt and have it continue going. Okay.
I don't know if you saw me get excited. I have to cut you off, but my perked up. I got a little excited when you said operating agreement, right? If you watch any of these videos, we harp on this time and time again. All of these things are provisions that are in operating agreements, and help define how you run your business, get the additional capital calls, things like that. So it's super important and often overlooked, to pay close attention to how these types of things are laid out in the operating agreement.
Right. And like I said, unexpected the capital calls, these are challenges for limited partners. They might not be expecting it. They might not even have the money available to invest in it to make this capital call. So there's going to be a lot of issues. So we're going to kind of go into, all right, what are kind of the ways to manage these, strategize for these from a fund manager level and then from an investor level. Okay. So if you are having basically debt come up, okay, you should be very proactive about this as early as possible. Most commercial debt, like I said, is short term, 10 years or less, but some stuff you might be using a bridge loan, which could be even shorter, 5 years or less. All right. There's a lot of debt that was taken out before the pandemic that right now is basically hitting its end of life and it's mature. Okay. And so these are tough times because the real estate market, the lending market, nothing is like what it was pre-pandemic. Pre-pandemic, okay, and even then, it's always changing. Okay, at the time of this video, we have a new president, but we don't. Nothing has happened yet. So, time this video comes out, there could be law changes and things like who knows what could happen, even in just a short amount of time. So, there's a lot of changing. So, you want to be very proactive here. The first is doing some sort of financial modeling. Okay, whether you're forecasting cash flow, budgets, this should never be catching you off guard. You should always be able to be like, all right, in my budget, in my cash flow forecast here, my my debt is maturing. Do I have the cash flow? Do I basically, even with the increase in interest rate, am I still going to be profitable? So this should always be part of your model. You should never assume that I'm going to just easily get new debt and it's going to be just as cheap or cheaper.
Never easy and not usually cheaper.
Yeah, never cheaper. Sometimes, but most of the time you want to expect that when I go out there and I got to get new debt, like I'm probably going to have a bigger payment, a little bit more interest. There's always a cost associated with that, some kind of loan cost. Do I have that covered? By basically being proactive and financially modeling all this in front of you, now you have plenty of time to get into the right space, get the right amount of money for this. Okay. Because like you said, the last thing you want to do is capital calls. All right. So even if you have to lower distributions to obtain more cash, that is a way better alternative. All right. Once your investors get cash, the last thing they want to do is give it back. Okay. So even if you have to pay under the preferred rate of return or something like that for a couple years to increase your cash reserves so that this isn't an issue, that might be a better route to go. All right.
Really great.
The second is kind of negotiating with lenders, trying to find extensions, creative restructuring. But you need to be talking to lenders as soon as possible. So if my debt is maturing and I go to them a couple weeks before it matures, you're going to get the results you expect. Okay. You should be going a year out, 6 months out before that. And you should always be maintaining great relationship with lenders and bankers. Okay. You never know what's going to happen. You need to be maintaining it the entire time. If I go out there and I create a 10-year loan and I only show up to the lender when I need a new loan in 10 years, don't be surprised that they're not going out of their way to help you out. All right.
It's like preparing tax returns, right? And, same kind of concept applies. Yeah.
Right. You need to be talking to them. Also, most lenders and a time where they're tightening who they're lending to, they care about their current existing clients. Okay. So if you're going out there with lending and you're not a current client in them, you're not a high priority to them. So what makes you a current client? That means, are you doing business with them in other ways outside of just basically your loan? Okay. Do you have deposits and bank accounts with them? Okay. Do you have lines of credits with them? Is there any other aspect? Banks make their money off doing a million different services, but I give you the little secret. They love your deposits. Okay. So if you bank with them and your deposits are with them, they're more likely to loan you money. Okay. Especially if you are doing a significant amount of deposits with them. Okay. So just keep that in mind. Like always maintaining that relationship the entire time. Make sure you have a couple different services. They're going to go out of their way to be with you, but make sure that even in the worst case scenario, you should always be negotiating, talking to your lender as soon as possible, even though the market might change in a year. Okay. In a market like right now, where say interest rates are coming up and you're like, I don't know what we're going to do with getting restructuring of this debt, please make sure that you're communicating this with your investors. Okay. That's the most important thing. You do not want to be surprised. Even if you're like, hey, debt is in a crazy spot, they know that already. They already know that the market is tough right now. They just want you to communicate that with them and say, hey, well, we're going to try and renegotiate on our debt here. Here's what we're thinking. We're talking to banks. This is what we're doing. And here's the projection of what it's going to cost. And if there's any chance that there's a capital call, that should be communicated as soon as possible. In worst case scenario, we can't get this to work out. There might be a capital call. That's the big parts kind of from like a high end fund manager. So let's kind of talk a little bit more from an investor. All right. Investors just do not want unexpected capital calls. But that doesn't mean as an investor yourself, you shouldn't be ready for it. All right. You should always be ready for an unplanned, unexpected capital call. That means always have something saved for something unexpected. All right. Just like you do in your normal life budgeting, everyone has a savings account or emergency account because life happens. You go to the emergency room, your kid falls down, breaks their arm, you need money. It's the same with your investments. He expected that some capital call is going to happen. Do I have something saved for that rainy day? All right. Two is you should always be evaluating your funds. They should be sending out, quarterly, semi-annually investor reports. Read them. Are you reading them? If they're communicating this to you and you actually did not read it, then that's your own fault. Okay. They're giving that information too, so you're not be surprised. It's one thing if they're not in that investor reports, but majority of the time it's actually in the investor report. Are you reading it? Are you looking at the numbers? You can kind of tell. Okay. Um, and then the big thing is realize that if you are an investor and you do have to put more money into the company, just realize that's not a deduction.
Sadly not. Right.
Unfortunately, it's not. Like I got to put more money in this company. Well, at least I'll get a tax deduction for it. That's not unfortunately how it works. You put money into the company that increases your basis, and then how that company uses your money will have some kind of tax consequence. But it couldn't create a deduction. It couldn't. All right.
In summary, read your reports and keep your emergency fund and you're in business.
That's right. That's right. And so that's just kind of some ways to kind of manage these strategies here. Um, and I probably should have just mentioned it earlier, but debt has a very important role here in real estate funds. It is a qualified non-recourse debt. Okay. We talked about how making a contribution increases your basis in your company. So does a qualified non-recourse debt. This is basically debt that is uh, collateralized by real estate. Okay. This real estate that you're basically purchasing gives you it opens up this whole tax code, which gives you a basis. Now I'm able to take losses and distributions and include my debt as basis for it. So this is how basically a lot of times these real estate funds are able to basically buy this huge real estate with debt and then pay back all their investors as soon as possible. All right. The cash out refi is what they call it. And then you still get to take losses. And so you're basically getting losses and your money back. Because the number one priority of an investor is to get their money back as soon as possible. So fund managers want to make their investors happy, which they do, because happy investors invest in more deals and make you more money. Then just know that basically, uh, you know, this is not qualified non-recourse is a really easy way to pay all your investors back without asking them to put more money in. So I can put more money in, but then I'm just giving you your money back at that point. Okay. So the qualified non-recourse debt is why this is really important. So you really want to make sure that when this debt is coming, capital call is the last thing you want to do. You know, you really want to restructure this debt, even if it's a little bit more expensive, but you should be planning for that when you're doing your budget analysis, when you're doing your cash flow forecasting, that these are the important things that you're looking at so that you don't have to call for extra money from your investors. It still operates at a high rate of return. And most fund managers make their money by having a high rate of performance on their funds. All right. The investors want it to perform well, and that's how you make your money. So just if you're a great fund manager, you're thinking about this. Okay. So kind of like looking ahead. All right. Like what to expect here. All right. There's a lot of unknown right now.
I was just like, we don't know. There you go.
Right. And depending on your asset class of real estate, it could be even different. All right. If you're in office space right now, you're in a tough time, right? A lot of people are working remote. Office space isn't needed as much. All right. That needs to be factored in. Okay. Retail is actually on the rise. Like we all decided we want to buy everything off Amazon and then we did it and we're like, man, I kind of miss those stores. you know? Right. I miss going in there and trying some stuff on or something like that. So retail's on the rise. How's that looking for you? Multifamily's kind of in a weird space. Like everyone always needs a place to live, but a lot of people have gotten in that game really quickly and it's really expensive to build multifamily right now. So kind of just look at where you're at because each asset you're at is completely different and then take the market. Where's the market going to be? I don't see a lot of significant increases or decreases from my point of view. So I think if you're able to put your thumb kind of on where the market is right now, that's probably what the market's going to be like in the next couple months as well. All right. Like, I don't think interest rates are going to go flying up. They might come down a little bit, but I don't think they're going to be so significant. Um, so expect the changes, you know, read what the economy is, read what the economists are saying about it. No one's 100% right. And then sure enough, I say all this, and then the new president will come in and make all these changes and everything will go chaos. But you also need to be planning for that too. Plan for any potential chaos. What if it isn't what I expect? Am I still able to manage my fund and get my investors they want? You know? So kind of like key takeaways from this whole thing that we just talked about with it comes to debt and capital calls. Most importantly is a lot of debt is short term when it comes to commercial real estate funds. So you need to be as proactive as possible and be talking to bankers and lenders as soon as possible to make sure that you're finding all the options possible for you, especially if you're wanting to restructure this debt. Okay. Um, Also, the fund manager, make sure that you understand what your top priorities are for your investors and that you're clear and you're not surprising them. And if a capital call is necessary, it does happen. You're communicating it as clear as possible, clear and as early as possible. Right? If you're an investor, expect the unexpected. Unfortunately, it's no one likes to get a capital call, but always be expecting it. Make sure you have the money on hand because the worst case scenario is a capital call happens and you don't have the money. What happens in that case? Most likely what happens is either the fund doesn't get enough money because too many people are not doing a capital call and it collapses and you lose all your money, or you just dilute your shares or your ownership in the fund. So, whatever your own, if you had 1% ownership and everyone else does a capital call and you don't, now you only have 0.5% ownership. All right. So now you're only getting half the returns you were originally getting. So always be expectant and make sure you're reading your investor reports. The investor that doesn't read their investor reports, unfortunately, is always caught surprised because the information was provided to you and you just didn't take it. Kyle, do you have anything to add right there?
Yeah, that is nice and thorough, my friend.
All right. Thank you for tuning in today's episode. We hope you found our discussion insightful and valuable. If you enjoyed this episode, please subscribe as we produce frequent videos related to real estate. Join us next time for more expert insight and tax strategies to help you maximize your real estate investments. Till then, stay informed, stay proactive, and happy investing.
To learn more about James Moore & Company's real estate accounting and business solutions, go to jmco.com. And don't forget to subscribe to our Real Estate Industry Update series to receive updates when new videos are released. If you'd like to be a guest, or if there's a topic you'd like to see covered on a future episode, contact us through our website or email us at info@jmco.com. You can also follow us on social media for more news as the landscape of real estate continues to rapidly evolve.